Bharat Mata Ki Jai. Jai Hind. It's always a pleasure to interact with an august audience of knowledgeable investors. We have had enough discussions in the morning today to deliberate on what has happened differently in India in the last few years. I think it's been a roller coaster ride in the last 16 months of Trumponomics playing out. Despite that, India's story remains intact, and the reason why we are all here today. What has changed in the last 5 years have been quite dramatic and quite transformative. I'm sure you'll all agree with me. And the change that has happened in the last 5 years is not at the surface level, but right at the foundation. The way things are imagined, rather, they have been reimagined. A strong foundation has been laid for economic growth for the country at large. From this perspective, one of the largest bastion of opportunity that we cite are based on the structural reforms that have happened in India. And the geopolitics getting realigned to build scale in India. I think India has arrived on global scale, global stage. Not only from the perspective of being provider of high quality manpower as we have done in the last 20 years, but more so from the perspective of providing IP-led manufacturing and products to the global stage. That brings us to the next stage of large opportunities that prevail in India, which are largely not captured by the world of listed entities today. Quite a lot of them still remain unlisted. And let me tell you, my friends, you know how many IPOs came up in the last year? As much as about 373 IPOs came up in the last, the calendar year 2025. And 373 IPOs, which is far ahead of the IPOs that have come into the largest market of the world, which is the US. Many of these entities still remain unlisted, undiscovered, and there is a whole world of opportunities lying out there. The ones who are able to lay their hands on them at valuations that are at a steep discount to the valuations that prevail in the listed markets are set to make a large pile of wealth for themselves and for the community at large. That's why we are here today to discuss about Bharat Transformation Fund. Well, just to give a quick background about what we are in a minute's time, it's been about 12 years of journey. I co-founded the firm Sincere Syndication. Well, we don't come from the school of fund management or private wealth management where we look at building products for the society, for the country. I used to run 2 power plants. I was a coal miner by profession. I'm a chartered accountant by qualification, by training. 25 years of investments in India and global markets. Few power plants in Southeast Asia, ethanol in the US, telecom in India. Led Kotak Mahindra Bank for Tamil Nadu about 20 years back. That's been my background. So we are not used to drawing lines on the Excel sheet, growing money at about 20% compounded to see where the value of the business is going to be. We are largely used to be sitting on the floor, on the shop floor, to understand what business models are all about. Understand the promoters, eat, sleep and breathe with the promoters, the founders, the management team, to see what they try to envision for the country, for their enterprise. That's how we have invested all over. And that's how we envision to invest for the next decade ahead. From this perspective, I think one of the most interesting things that have happened today is to be able to invest in undiscovered opportunities, right? This is our management team. We have esteemed professionals who have come from diverse backgrounds. The gentleman you see at the last is one who runs an AA academy. And the third one who sits one amongst those people seated here was CEO of Adair Burn. He ran an enterprise, built an enterprise from 600 crores of revenues to about 1,500 crores of revenues. Hotel business that was set for listing. If you know Adair Burn, based out of South India, the largest restaurant chain in India, CEO of the restaurant chain, and this is myself. The second one is next banker. He was head of South India for HDFC Bank. We are all been bankers, we have all been investment bankers, we have all been investors, professional CFOs and CEOs of companies. Well, this is where we are going to be investing through Bharat Transformation Fund. I think this is where the opportunity lies, the next big bastion of opportunity. We invest right from the stage of discovering ideas that are set for listing in about 24 to 30 months time to investing post-IPO after listing. probably about 1 or 2 years post-listing. And of course, there are a whole lot of ideas thanks to the market volatility in the last 16 months. I think the market is still attractively poised today. The growth rate in small caps running at about something like about 26 to 28% in the last quarter. I think we're attractively poised in terms of valuations, even in the listed markets. That be the case, let's cite a classical case of a defense company that we're going to be investing this month. We're doing due diligence on three to four defense companies and aerospace companies in the last 2-3 months. One of them, let's take a case, an example. Typically, what's the valuation of defense companies in the listed market? I'm not talking about companies that supply coats, suitings, or nuts and bolts to defense. I'm talking about high-tech defense companies that, let's say, manufacture radars, that manufacture anti-drones, not drones which have already become commoditized, because you see a drone company almost in every street of India today, right? I'm talking about high-tech defense companies that have an IP to own and supply products which are differentiated in the market. What's the typical valuation today? Don't we see valuations running at nothing less than 50 times of earnings? Don't you agree with me? Somewhere in the order of 50 times to as high as 120 times of earnings. So we are looking at investing in a company that is running at the PAT of about profit after tax of about 60 crores for this financial year, should end up at somewhere around 60 crores. But based on order book on hand, should be ending up with profits of about 150 to 200 crores somewhere in 2026 notice on, based on order book on hand. They manufacture loitering munitions, high-tech equipment, high-tech products that hits the targets with high level of precision. There are only 2 companies globally which can hit targets with precision levels of less than 1 meter of precision. Most of the loitering munitions that are manufactured globally by defense companies have precision levels of between about 2 meters to about 10 meters. Just imagine a tank, just putting a tank in front of you. Imagine a war tank. If a drone or rocket is going to fall on a tank, imagine a rocket falling on the bonnet of a car. What would happen to the car? Wouldn't the car do an ulta and fall apart? That's what could happen to the tank if the rocket is going to fall at the fag end of the tank. But where should the rocket fall upon? Where should the drone fall upon? It should be right away falling upon the headgear, isn't it? The place where they're going to open up the tank, right? And what's the size of circumference of that place? It's less than a meter. It's actually 3 to 4 feet in length and breadth. That's the kind of precision that is required on a target that's going to be hit from a place which is about 1,000 kilometers away from the zone. Precision, immaculate precision. There are only 2 companies globally that can hit the targets with less than 1 meter precision, one of which is a Israel company with which our investee company is partnered with, and that's a high-tech product and equipment supply that they're doing to Army, Navy, DRDO. And this year's PAT, I say, let me reiterate, is 60 crores, bring it up to your memory, 150, 160 crores of PAT next year. They're going to be getting listed 1 year down the line, which is what is likely to happen. What could be the typical valuation? Take it at the same 40 to 50 times, leave alone the euphoric valuations of 100 times, which is going to get listed at about 50 times of earnings, right? Wouldn't it find valuations of anywhere between 6,000 crores to 9,000 crores? What if we get an opportunity to invest in such a company at a valuation of about 1,500 crores today, which is as much as only 10 times of earnings? Forget how much of money could be made on this. Doesn't it provide a large significant margin of safety to us? What is investing all about, my friends? With all your decades of experience in the community sitting around, I guess some thousands of years of experience should be prevailing amongst the community of investors sitting around here. The most important principle of investing is not to lose money, isn't it? Where does that come from? Does it come from identifying great ideas? It doesn't come from identifying great ideas alone, but investing in those companies at reasonable valuations. Valuations from which you can actually make money. That's a margin of safety. Let me tell you, the margin of safety, if you're willing to make your hands dirty, go to the shop floor, sit to the promoter, meet the management, spend time over there, spend weeks of due diligence out there, pick up your picks, get your picks right. Then let me tell you, the valuation discounting that you see in the pre-IPO market, if you get lucky, is as much as about 70 to 80% to its listed peers. And nothing less than that. In this very company that I talked about, if you're going to be able to pick up a 1,500 crores valuation at 10 times of earnings, and if it can get listed at 50 times of earnings, or 40 times of earnings, don't we see 4x returns out there? That's what Bharat Transformation Fund is set to capture. Great opportunities in the transformative world of The Bharat that is emerging today in sectors that are off focus of the government, where the growth rate of the industry itself is running at nothing less than 20%. And if you're able to capture these opportunities by investing in the best of entrepreneurs, right? Those entrepreneurs who could grow enterprises at least 2x of the industry's growth rate. You're not going to get it too wrong, right? Now, these are the basic filters that we are applying, my friends. Well, it's been about 20 years of investing, also learning experience in running enterprises. Let me tell you, the important facet of investing in listed markets largely comes from learning the numbers, understanding the numbers, because history is available to you. But how do you see this 100x happening in companies that are unlisted? How did this 100x happen? Did it happen because the company was able to grow its compound its profits? Certainly not. That is the case of 10 to 15% compounding. That is the case of 15 to 20% compounding. 100x happens because of factors that are largely softer in nature, not just numeric numbers. When we went into the annals of Indian history, not only Indian corporate history, but global corporate history, and looked at entrepreneurs and looked at enterprises that generated 100x. Call it Bajaj Finance, call it HDFC Bank. What are those factors that laid the ground for this 100x? We learned that these were those 4 factors. And let me present it to you quickly in about a minute's time, couple of minutes' time. The first and foremost of them is to be able to invest in visionary entrepreneurs. Do you agree with me? Not in entrepreneurs who look at incremental growth of 15-20%. Not on entrepreneurs who look at creating scale of about 15-20% growth and capacity. But in entrepreneurs who are able to visualize things that do not exist at all. They see things that others don't see. What others see that they don't see. Those are the visionary entrepreneurs. They are fearless in nature. They are not only fearless in nature, they are able to have deep domain expertise. If they don't have it, they are able to build a team that will bring the domain expertise. They are influential in the networks. Typically, we have invested in quite a few startups too. In the last 12 years, we've done about 22 investment startups. One important factor that we see when we invest in entrepreneurs is that we should not be doing the selling part for them after we invest funds with them. They should be able to scale their own story. They should be fantastic narrators of their own story. They should be story builders, narrative builders, right? They should be sitting among the powerful network of investors. So to be able to raise funds and build scale, influence the networks, execution foresight, integrity as a compass, no compromise on integrity, isn't it? Governance standards. If these 5 factors exist, we see that they are visionary entrepreneurs. Just put it like a checklist is what we have done, right? So visionary entrepreneurs, if those visionary entrepreneurs for a moment sit on industries that are very traditional, growing at about, let's say 6 to 7%, let's say steel industry. What kind of good that they can make out of steel industry? They're going to be sitting in a textile industry with all due respects. If they're a textile entrepreneur sitting here, are they going to be producing about 40-50% growth? Perhaps they can get into technical textiles. That could be a bit of a game changer, but it's only going to be an incremental game changer, right? Therefore, the most important thing here is to have them seated in tailwind-backed businesses, industries. Tailwind-backed industries, hugely tailwind-backed industries. Haven't we heard this proverbial saying often? The rising tide will lift all boats up, isn't it? If a stupid is if I'm going to sit out on an industry which is growing at about 40-50%, I'm not going to do anything nonsensical out there, I am also going to be lifted. What if a visionary entrepreneur is sitting on such tailwind-backed industries? He's only going to compound the growth rate of the industry itself, isn't it? So what is a tailwind-backed industry, my friends? I may have a definition, you may have something else. This is what we believe to be tailwind-backed industries. Let me tell you, let's face the facts. You may call India to be democratic, which is what it is. But the truth is that 18% of corporate India is owned by whom? Who is the largest investor in corporate India? Indian government, right? Either directly or indirectly, they own 18% of entire corporate India. Meaning that whatever they find it to be the industry of future is what the tailwinds are going to be. Therefore, policy paradigm shifts, geopolitical realignment, structural demand shifts, tech disruption and adoption. If you find industries that are the intersection of all these 4, that fulfill all these 4 criteria, call them tailwind-backed industries. Visionary entrepreneur sitting in tailwind-backed industries alone does not suffice because, well, the critical point is, does he have a professional management? Or is he going to be the CFO? His brother's son is the CFO of the company. We wouldn't invest in a company unless and until the visionary entrepreneur has embarked this journey with the hands of professionals empowered in the system. Right? There should be a CFO. For example, let's take once again, go back to the case of a defense company they talked about. Visionary entrepreneur, yes, he's doing fabulous work, but he's got a CFO, coming with a track record of about 25 years. 25 years of track record, of which about 15 years spent in defense, hardcore defense. He wouldn't want to, a chartered accountant with 25 years of experience, wouldn't want to put his career at risk to be part of some shady systems, isn't it? Therefore, having a professional management solves 50% of the problem, isn't it? Don't you agree with me? Professional management takes over the emotional bias and provides an execution advantage. That's what professional management is all about. But here again, there is one catch. If all these things prevail, but they are solving a problem at a surface level in the society, I don't think they're going to make a difference because the moat doesn't get created. Where does the moat get created? Moat is something that we often associate with in investment jargon, as an investment jargon, isn't it? We believe that the moat gets created if the enterprise is able to solve a critical problem that prevails in the society. We wouldn't want to invest in a company that doesn't solve a problem. There are many situations where a company creates a need. That's probably the case of a Jio that was created by Mukesh Ambani. Right? We wouldn't want to invest in a company that creates a need, but we would want to invest only and only if the problem gets solved, and that too it's a critical problem that gets solved. Why is that? Because the more the criticality of the problem is, the deeper should be the solution that gets provided in order to solve that. The deeper the solution, the longevity of the moat is ensured. The longevity of the moat is ensured by the criticality of the problem that is solved by the enterprise. Think deeply, I'm sure this will resonate with you. Therefore, these are the four factors essentially. I'm just putting some kind of, in front of this august audience, a particular ideology or framework, which is our set of cardinal principles. Visionary entrepreneur in tail-backed industries, solving critical problems in the society, aided by a professional management, is a classical case for investment. Now, if you find those companies, at valuations which are 50% discount to the listed valuations, would you still grab it? Yes, you can grab it, provided they are set for listing in the next 6 months to 12 months, or at least within the next 18 months. So what we envision to do here is to be able to invest in companies, or rather we are investing in companies which are set for IPOs probably next 18 months or 24 months. Do one cycle of investment, let's say, take a case of, take for a moment, 1 crore of rupees that gets invested in enterprise, grow it to become about 2.5 crores, or 2.5 crores, if you can, and do one more cycle of such investment and exit. Such is the advantage that prevails with the opportunity in the pre-IPO world. If you can generate about, is it let's say 20% growth is a possibility? Yes, I think 20% plus growth is definitely a possibility. 25% plus is a possibility? I think yes. That's a kind of opportunity that prevails in the unlisted world at this point in time. Well, what are the kind of industries that we're going to look at? Let me take just a couple of minutes to round you up with the kind of industries that we're going to look at. Defense and aerospace. I'm not going to talk very deeply into those industries. I'm just going to leave you with some broad heads up on these industries. I'm sure most of you are quite on top of most of these industries, right? Defense and aerospace, precision engineering, advanced manufacturing, deep tech enabling platforms, specialty healthcare, medical devices. 90% of medical devices are important in India, isn't it? Affluent consumption. These are the sectors of focus, right? And well, here, my friends, if you look at these sectors which have been driving the growth rate of India's economy, where capital formation is happening, right? You'll find something very, very interesting here. See, look at this particular chart. During the time when, the Chinese economy, the Vietnamese economy grew significantly over years, what happened? What happened was something, transformational, right? This is what has happened. India is moving from being consumption-driven economy to an investment-led economy. Do you agree with me? Moving from a consumption-led economy to an investment-led economy makes a whole world of difference here. And private capex, increasing quite significantly. Government capex having grown at 19% in the last 5 years. That has been the driver. That has been at the rate of the start of this entire cycle, right? And what has happened after that is that private sector capex has started picking up, as we all know. But look at this important point here. This is a time when Thailand, China, Indonesia, and Vietnam, and those respective periods, grew at more than 9%, grew their GDP at more than 9%. Look at this carefully for a moment. When you find that these economies have grown their GDP at more than 9%, the manufacturing sector specifically grew the manufacturing sector as a share of its contribution to the GDP grew from 21.9% for Thailand to 28.2%. For China, it grew from 9% to as much as a behemoth 32% during this period from 1990 to 2005. Don't you remember? This is a period during which the capital formation happened in China, isn't it? During that period, 9.1% contribution to GDP of manufacturing grew to 32%. Now, where are we today? We are at a point where the manufacturing sector is contributing only as much as 15% of GDP. If Indian economy can continue to grow at anywhere between 7 to 9%, can manufacturing grow from 15%? Can we repeat China? Can we repeat China? But during this process, if at all we can repeat China, let me tell you, this manufacturing that we're talking about may not come from cement, may not come from FMCG, may not come from steel, may not come from any of this commoditized manufacturing exercise, because manufacturing is going to get commoditized. If at all it's going to come from manufacturing, if at all manufacturing is going to transform itself, it's only going to come from IP-led manufacturing. IP is a game here. Owning IP is a game, right? Now, citing a case in example, these are the three large drivers we feel could change the picture of India. IP-led manufacturing, digital economy, and affluent consumption, right? Here, these are sectors, the one that we talked about, when you looked at it carefully, these are sectors, the one we talked about earlier, which is aerospace, defense, and the precision engineering, electronics, semiconductors. These sectors could grow as much as at twice the rate of GDP of India. Can we not participate in these sectors, of which more than 70 to 80% of companies are still remaining unlisted, are yet to be discovered, right? Now, aerospace, for example, is something like about 350 billion, at this point in time, about $240 billion industry, likely to grow to about $400 billion industry. You know what? This is something interesting. Unlike most other manufacturing industries, what is the contribution of China to this aerospace? Can you guess? More than 85% of aerospace industry globally comes out of Europe and the US only. China does not have a share of manufacturing in aerospace. Why is it? I don't know why, what the rationale could be, but I imagine that perhaps the risk of IP theft perhaps is the reason why China has not been able to adopt to aerospace technology, right? Now, what if, let's say, somebody nudges, some manufacturing company in Europe or the US nudges away a little bit, a small portion falls apart from Europe and falls on the land of India, let's say $3 billion moves out of. What is the contribution of India today? It's less than 1%. Less than 1%, my friends. It's as much as only about $2 billion that goes out of Indian manufacturing to the global aerospace. The global aerospace market is consisting of the likes of Boeing, Airbus, Lockheed Martin, Pratt & Whitney, so on and so forth, right? Less than 1% comes out of India, right? If a small nudge happens from Europe, which is what is happening today, to move manufacturing of about $3 billion to come to India, the Indian manufacturing in aerospace can actually grow by 2.5 to 3x. And how long could it take to happen? We believe that it could happen over the next 2 to 3 years. Enterprises are set to grow there. There are 4 levels in aerospace: L1, L2, L3, L4. L1 is constituting the assembly manufacturing, then comes sub-assembly, component, subcomponent. L4 is subcomponent. India is at the point where we are moving from being L4 to L3. A long way to go, miles ahead to go to become L1 and L2. There are only 2 companies in India that are L1 at this point in time, supplying to Pratt & Whitney assemblies themselves, right? But I'm sure over the next 5 years, lot more enterprises will emerge. If not L1, definitely at L2. You know the difference between L4 and L1? The margins in L4 typically in Indian context remains at anywhere between about 14 to 16% at EBITDA level. As you move up the value chain, the margins in L1 can be as high as about 40%. Let me give a comparison. An L1 company in Europe producing the same component, same assembly, of which Indian company has got a margin of 40%, will have a margin of nothing more than 16% in Europe. Why is that? That's where the cost arbitrage comes in. Now here is a composition of 2 things put together, intersection of 2 things. One is cost arbitrage. What happened in IT industry, what happened in healthcare, will happen once again in aerospace. The cost arbitrage of India, along with the IP emerging in India put together, can create compounding of sorts. Now this is aerospace for you, right? We identified specific segments in aerospace, subsegments in aerospace where we're going to be invested. Then defense. The defense, as we all know, is a very, very large market, but I'm going to leave you with only one thought in defense, right? There is a specific market in defense, right? The one that, it's not a commoditized market in defense. one specific market which is a new age tech in defense, which is potentially growing at about 20% per annum. It's this tech-led defense manufacturing that we are focused upon. That's a very large opportunity. And over time, the market share of defense, tech-led defense in India as it stands today at 28% can move up to about 48%. Now, what is tech-led defense all about? Let me demystify. Just to give a broad picture, artificial intelligence, UAVs, loitering munitions, counter-swarm, drone systems, electronic warfare, and SATCOM. To give you an example, how many SATCOM companies in India? You may do your own research. You will be surprised to find that there is only one listed SATCOM company in India. And most of the SATCOM products that are used by Indian Army and Indian Navy until date are imported. As much as 95% is imported. Right? That's a large opportunity in the tech-led defense area. Right? I can go on rattling around the opportunity that prevail around. We're very excited about what's happening around. Very large. The size is very large. MedTech for you. Right? Medical devices, affordable healthcare, India's affordable healthcare market of the world. Now, the way we could be moving at this point in time, not only being an affordable healthcare provider, but what could emerge over the next 5 years could be affordable healthcare manufacturing setup in India. Right? With all this, we are quite excited. I'm sure most of the fund managers sitting out here are very excited about what is going to happen. I think large bastion of opportunity doesn't remain in listed companies alone, but in reality, it remains in the pre-IPO space. It's not about investing in, take some names with all due respects, the national stock exchanges and Tata Capital's award. That's not what pre-IPO that we ascribe towards. That's not what we are talking about. It's not stocks that are available on ICICI Direct and HDFC platform where investors go and buy. Those are all companies perhaps for all those uninitiated where the valuation has already been factored. It's already available in the retail market. How do we create value out of it? I'm talking about sectors and companies which are yet to be discovered, where we need to go and sit on the shop floor, meet with the promoters, spend time with them, understand, dissect the business, and then invest. That's a large opportunity space for all of us. That's a white space. The large canvas yet to be written upon, and we're not going to be missing that. Right? I can go on rattling about a bunch of other sectors. That's going to be the opportunity at sight for us. But with this, I think this is a wonderful platform where brilliant fund managers have come together, share ideas, and every hour of my spending time with my colleagues around in the industry has been a great learning. And thanks to PMS Bazaar for organizing such a wonderful session today. Wish you the very best. Jai Hind.